Hey, good morning. How are you? Fantastic. You and me both, Jim. Guess it's time. Nice transition. All right, wowzer. That's a good omen. Hey, welcome. Hope you had a wonderful long weekend. Hope you had an opportunity to honor those who have served. Thank you for your service. Never seems adequate enough. I never know quite what to say. Never seems good enough. Thank you for your service. Thank you times a million above that. So, anyways, welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. Yes, Jim, and there is that distinction. I don't know if we do the same in Canada, but here in the distinction, right, there's a difference for those who have served and then for those who have lost their life serving. And so in Canada, we have Remembrance Day, which is the armistice of World War I, right? The 11th hour of the 11th day of the 11th month. Yeah. But I'll tell you, I understand that our society that we live on, this freedom, and I see the signs a lot, but it's meaningful. The freedom wasn't free. And there was a while where we were trying to figure out the right way to rule our societies, and having having personal freedom wasn't necessarily a guaranteed thing. So it was earned. It was earned. So, anywho, I'd like to start out by letting you know that the site for summer school is up. We've talked about this, and I'll put the link here. You can sign up. We are starting in not so distant future, 13 days. We're going to do it on the TRADARS site. We've done it in the QuantBox site. We've done it in the Bootcamp site. This one I want to do TRADARS because I want to bring in some of the tools that we're using over there, and maybe I'll be adding some tools. And it's very much focused on getting you experienced at pulling the trigger on trades, very experienced at gaining a personal confidence based on a reality, right? Like, we're going to track your abilities and show you how to do that. So it's a confidence through skill building. And this is probably the most practical and interactive summer school ever done. Where before it's just been lecture, and you sit there and you're like, yeah, that's interesting. This is very, very practical, very interactive, very participation is required. So anyways, it'll make a difference. And this came from our conversations that I've had recently with traders, and pulling the trigger for multiple different reasons was a challenge, either psychological or tactical, meaning you just didn't know quite when to do it, and therefore you were always super late or super early. So whether it's confidence or technique, this is what will be addressed this summer, and it'll be fixed. Yeah. Okay. Cool. Another thing you're going to need is a broker that doesn't trade against you. For multiple reasons, I think you need an ECN with straight-through processing. And Trader's Way is the one that I use. I've used for almost 10 years now. Yeah. So start your career off correctly by having good service providers. QuantBox helps you automate your fundamental analysis. So if you want to organize your trading logically so it looks like this. Here are the things you're interested in buying. Here are the things you're interested in selling. Right now you're watching but ignoring. Watching but ignoring. Everything neutral. If your trading doesn't look like that, you're not trading properly. It's just simple. Basic. It's hard. You might not have a macroeconomics degree. I do, and I built this to automate my process. And you also, how would you like a technical analyst working for you? Yeah, how'd you like a technical analyst working for you? There you go. Hey, Adam, I hope you saw my email. Yeah, awesome. Okay, one thing to point out for those that are not using QuantBox yet, I've added two things to our dashboard last week. The first one was a put-call ratio that looks at the options trading community and derives whether they're risk on or risk off. This is looking at options traders. How do they feel about the market? And today they are neutral. Literally one, which is neutral. Last week they were risk on. Right now they're neutral. Okay? And anything above one, they become risk off. So we're asking an entire constituency, how are you trading? Risk on or risk off? Hawkish or dovish? Okay? And we have a quantitative answer to that. And I put it on the dashboard so it's easy to find. The next thing that I added was the yield on the 2-year Treasury. And then we threw down an 8-day moving average just to show a crossover. And in this case, what we're seeing is the yield on the 2-year is rising, and that is bad. Risk off. This is moving in a risk off direction. Okay, we were risk on in the, right? So this is the Treasury market. These are the options trading market. They're risk off. When we add even more constituencies, we're looking at volatility, we're looking at the stock market, we're looking at gold, we're looking at yen, we're looking at yield on the 10-year. See, the yield on the 2-year is kind of like a money market, and this is much, a much different duration. Think of it as an investment community versus a money market. Here's the dollar, and right now nothing's really gotten going yet. And then week over week, nothing's really gotten going yet. Remember, yesterday was a holiday. And on the monthly evaluation, we dropped from a 4 to a 3. So nothing is going on quite yet. Okay? But anyways, we're not here to do QuantBox. I just wanted to point that out. Okay? So we're adding more and more evaluations, if you will. How are other traders trading? Because we're trying to go with the flow. And you want to know when to hold them, know when to walk away, and know when to let your winners run. Okay? So imagine all the different players in the market. Options traders. Money market traders. Bond traders. Stock traders. Commodity traders. What if they were all risk on? Then you shouldn't be scalping, bro. Okay? Let that swing. You know what? I may have accidentally turned my platform off. Hang on. There's that sweet sound, huh? There's that sweet sound. Okay, so we haven't gotten together since late last week. Zoom in a little bit. And, well, we've hit our profit target. Okay, we've hit our profit target. Well, hell's bells. Taking a look at the trade since last week. Let me just open this up. I have equivalent of 350 pips. NASI, S&P 500, and Euro Yen. Okay, so why don't we start with those? Oops, wrong one. Sorry, my bad. Okay. Let's take a look. Okay, and the big question of the day is, can we get through? Okay, here's the delete. Let's do this in black. Okay, so, you know, can we get through that? And that's tomorrow's target. My entry on this is right here. Okay. Oh, right on, JP. Okay, so this was something that we did on Friday at my live stream on the FX Street YouTube channel. Okay, very cool. And a little bit of capitulation here, obviously, topish. And I would like for this to stay above this area here, huh? That's what I'm looking at. So that would be risk on. So what we're looking at for today is this zone to hold as support. If it starts breaking down, then yeah, we got some problems, right? Hasn't happened yet. So there's your nizzy nazzy. Here's my trade on the S&P 500. Look at that. Yeah, holy smokes, that was close, huh? So anyways, now what? Same, only different, right? So we got this going on. And the market's not so sure. Okay, the market's not so sure quite yet. Could set up a head and shoulders though, huh? And that's what Dow is warning you about. But I don't know if NASI goes up today. Now, why would NASDAQ go up today? iPhone sales in China are up 50%. They went from 2 to 3. Hey, but month over month, Okay, so if you wanted the Nasdaq to run today, that would probably be good enough. But Dow is kind of playing a different game, isn't it? And meanwhile, S&P's caught in the middle. So, if, oops, that was terrible. Let's do this differently. Let's do it like that. There we go. Okay, so if this holds, then something like that sets up, right? So we'll see. It's something to be concerned about. It hasn't happened yet, so don't be concerned. But you should be aware of it. It's a threat to bullishness, isn't it? Okay. Okay. So how about no diggity, no Dow? Yeah, this is where it becomes a problem, right? Oh my Lord, did that break down? Holy smokes. Yeah, that's definitely on the terrible side. But we have approached the June buy zone. But, oh my gosh. Okay. Now, I wouldn't have expected that, but that's definitely what happened. And I suppose I'm lucky that I don't have a lot of cash on the Dow. I'm much more S&P 500 weighted. And I've even pulled some money out of NASI and put it back into S&P just to balance. Al says PCE, yeah, well, specifically core PCE deflator, but that's not till Friday. So anyways, so I've moved money to here and moved money over there. My portfolio beta is 0.2. Extraordinary. Yeah. Efficient market theory. Oh my God. Yeah, really? Yeah. And index investing. Yeah. Yeah, well, the problem with index vesting is you will die broke. Yeah, right, which means you have no alpha, Richard. Guaranteed no alpha. All right, let's look at the dollar. All right. Okay. Back above our zone. Bring it across. Okay. Okay. Risk-free asset plus risky asset? I'm not sure what you're talking about. Okay, let's take a look at another one. Okay. Once again, this looks to be risk on. You got to measure this as a potential top and then drop in. A low standard deviation. Yeah, so I guess by risk-free asset you mean treasuries. So you're saying buy treasuries and a stock index. So why would you want a treasury? Don't tell me the negative correlation, because we haven't had negative correlation since 2008. Is the goal low beta? All right, so how about this? Let's go to the next thing. Okay, your compensation for risk. So let's say a low beta is your first thing. Okay, I'm going to share something that is unbelievable. I actually had a conversation over the weekend with a professional money manager. And we did one of those things like, if you show me yours, I'll show you mine. So he sent me his track record. I'm like, cool. And I sent him mine, and he's like, that's unbelievable. I'm like, I know, it's stupid. He's like, so anyway, so another one is, so you have a Sharpe ratio, right? And that'll show you, let's say, risk and return over all market conditions. And a Sharpe ratio of 1 means you're going to be compensated for the risk that you're taking. Now, you want that closer to 2, and you certainly don't want it to be, less than 1 or significantly less than 1. You want 1 plus. And it turns out, well, my Sharpe is about 1. So you're like, Wayne, that's not very good. No, it's by design. So like when the stock market goes up, I only go up a little bit. And then when it comes down, I only come down a little bit. And by design, I'm cutting the tops and the bottoms off. Okay, and that means I'm overproducing or under, I'm lagging or on the up and I'm lagging on the down. So what happens is you get a balance. And you're like, so that's actually good because that's design and I have low volatility, but I'm getting a return to compensate for risk, which is good. But then you do a Sartino ratio, which he worked with Bill Sharpe on the Sharpe ratio. And so Sartino came along and said, there are times when you want to perform. Like there's good risk and bad risk. This is all volatility. Then there's good volatility and bad volatility. And so like, are you going to get compensated on the way down, which is really what a lot of investors are looking for. How are you going to do during the bad times? Okay. And so once again, you want to be above 1. And if you're near 2, you're extraordinary. Average is about like average good. Like you have to, if you can't do 1, you're not doing anything right. So, you should be pulling a 1.5, which means when things are tough, you're more than compensating for the risk. Okay. So a 1.5 would be good. A 2 would be very good. And I'm doing over 5, which is stupid. It's like a 5.2 or something. It's not even on the scale. They don't even have a scale that big. And what that is saying is overall, all the time, you're getting rewarded for risk, but I only have 20% of the risk right now. Maybe just because of recent conditions, but I have much less volatility than the general market. And when times are normal and good, you're getting compensated with lower risk. So that actually risk-adjusted performance is good, but net asset value is low, but income is high. But when people are losing money, this fund is going to outperform by a lot. And so, like, Richard, you're going in the right direction, but that's what it feels like you're regurgitating, and I don't mean this as bad on you, but what's in a textbook, and what's in a textbook doesn't work anymore. So the formula that you're doing, like a risk-free asset, right? Oh, I know, and this is why I'm sharing. A risk-free asset plus an index is going to get you nothing. Yeah. It'd be like guaranteed mediocrity. And that won't cut it anymore. What's worse is that it could produce negative correlations so that when the stock market's falling, your treasury market's falling, and you're losing money across the board, and therefore you don't have a good beta. Okay? So in 2005, what you shared probably made sense, but in 2020, 2021, 2022, if you had built a portfolio like the one you're talking about, you would have done it extremely poorly. And unfortunately, this is what's still taught. It's still in the textbooks, and many wealth managers still think it. Okay? The 60-40 is a guaranteed loser. And yet, for many, the debate is it a 70-30? Is it an 80-20? And it's totally the wrong debate. And your financial advisor really doesn't know what they're talking about. What about putting commodities? You're changing the structure, the profile, and all that kind of stuff. Well, you're going to have different volatility and different correlations, and but the answer is maybe. But now, who are we talking about? For the average person, is it their retirement account? Is it their 401k? Well, there are things you can and cannot do. So, anyways, it's a start, Richard. Like, learn it, and then realize that's what worked in 1992. 1993. And the world changed when central banking invented quantitative easing. And now we've even moved away from that, and we're doing different things at the central banking level. Sure, quantitative tightening, but then there's other ways that the Fed runs itself. So I don't know if it's tweaking. It's just wrong. Right? It's not tweaking. So, for example, let's say your treasury, your risk-free investment with an index. Okay, so the index will get you average. Okay, it's diversified. Great. Depends on which one you take. It has a different profile. So I'm going to say the S&P 500. But does the Treasury have a negative correlation? No. Is it going to provide balance? Is it going to lower your beta? No, probably not. Or if it does, not significantly enough. Okay? And is it the free market? This is the real thing. Does it truly represent? Like, why is it underperforming versus before? Well, the Fed has been selling treasuries. Okay, that's one problem. And before that, they were buying treasuries. And now we just found out that they're going to slow down the amount of treasuries they're selling. Because why? Because they're breaking the market. And before that, the Fed wasn't a major player. They just maintained interest rates. They were not a major buyer or seller. They were not a market creator or a market maker. But they have been since 2008 when the Fed did QE1 and then QE2 and then Operation Twist and then QE3. All of these things killed the free treasury market and the 60-40 or any variation of a 60-40 portfolio. But unfortunately, the The average wealth manager has a sports marketing degree. And they just sell whatever they're told to sell. They're salesmen. They're not economists. They're not, right? Wouldn't it be amazing, like, let's say you start interviewing financial advisors, and you're like, oh, before I give you, my entire net worth, why don't you show me your financial health? Wouldn't it be amazing? Yeah. Anyways, so you're going in the right direction, but like, Richard, you should probably join the CIA at some point. Because you're asking good questions, but just be careful. The textbooks are wrong. So like my Harvard stuff was like Mankiw. We read a lot of Mankiw. He's a Harvard guy, and most universities use his stuff. But I think even that might even be wrong. But anyways. Yeah. All right, so look, are we going to get a breakout? Well, this sucker's got to catch up, and then we break to the north. We need risk on for that. Is that going to happen? Well, I don't know. There's still time. Seasonally, you would expect there's still time. And the other thing is, it seems like American companies are making money, and so therefore maybe the stock market can continue up. And if it can continue up, euro dollar is likely to go up with it. But we're not there yet, so you should have concerns about a top. But if you're a bull, be a bull. Are you a bull? I might be. No. If you might be, then you're not a bull. Okay? So anyways, nice. So Kiwi, having a good one. That's a risk on. Okay? Pig Dogs had its move. Very nice. So there's some potential here for risk. We can go to the yen pairs, see how they're doing. And, here's what I would do if I was me. I'm going to leave it in this kind of context here. I don't want to dive into every single one. If you're a bull, this is a buy zone, somewhere between where we are, which is what I call role reversal, and into probably a dip off of the moving average. The one thing you'd probably want to check is the next month's pivots. Okay, Aussie. Oops, of course I expanded that. I want to leave it here. Aussie is already gone. Okay, it's already gone. It's already gone. What are you going to do? Okay. Let me back this out a little bit. Okay. Of course, these are supposed to be set bullishly. But once again, like, you're logging into New York, and if you're asking me what you should do today, you should take profit on stuff you did yesterday or the day before and take the rest of the day off. There's quite a bit of down before and up. We're very close to here. Very, very difficult to just start doing something now. I mean, that's the thing. Like, if it's New York and you're just starting your week, that's one of the mistakes you're making. Okay. All right, so here we are Tuesday. We already hit target, and we dropped like a ton of bricks. Okay. Okay. Hang on to that thought, Richard, because my first thought is you sold pound yen, but it's an uptrend. If it is, we'll take a look at it. But like, I don't sell uptrends, right? So we'll take a look at that in a second. But you can see what I ended up doing here is I bought a roll reversal. Is that okay? Yeah, it's okay. Okay. So here's my buy. Up, 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 down, down, buy. You can add another one. Up, 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 down, down, buy. You can add another one, right? Up, 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 down, down, buy. Up, 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 up. And we hit this, we hit. And then boom! Shalakalaka. Yeah. Yeah, that's a bit of a conundrum, huh? Okay. Easy peasy lemon squeezy, right? So again, just to put this into context, up, 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 down, down, buy. What do you think? Is that okay? But remember, like, I have rules of engagement. This is bullish, I only buy. Okay? That's it. Okay? Ride the 21, baby. Ride the 21. Okay? I'm a simple dude. That's all I need. All right, let's look at the pig. Okay, Richard volunteered and sold this. Okay. Okay, well, let's break this down. Since May 9th, I'm a bull. I can only buy. No, grumpy cat. This is why we need summer school. I'm also going to do a presentation as well on the pattern trading and all that kind of stuff. Okay? Remember, TRADARS sees patterns. Oops, TRADARS. It's not fundamental. It doesn't have a bias. It's trend agnostic. So for example, in an uptrend, okay, it'll see a pattern and it'll say, oh yeah, it's going to fall. For example, I don't know what you saw. Okay? Does that make it a good sell? No, that would be dumb. And I'm exaggerating for effect so that I'm hitting you hard. So I don't know what you saw, Grumpy Cat. But never do something because like TRADARS saw. TRADARS would have seen some sort of bearish pattern. That's true. But I'm going to hit you like I'm hitting Richard here. I'm a bull, so I buy dips. So if there's a down channel here, it just helps me get set up. I buy in this zone. Okay? So for example, look, it fell for a day. Good, buy it. Look, it fell for 2 days. Good, buy it. Okay? Look, it fell all Monday. Good, buy it. I only buy. And when you're a bull, but TRADARS says down, it sees a bearish pattern. So you should expect a move like this and then buy it, or a move like this and then buy it. So again, I'm not sure what you saw, Grumpy Cat, but you are bringing a point. And I always pick on the language, right? And so when you're like, I sold it because TRADARS told me. No, it didn't. TRADARS told you there was a bearish pattern. But if for example, it's a bullish trend, then you would never, ever, ever sell a bullish trend. Right? And so if you're a bull and TRADARS sees a bearish pattern on FTSE, it means go cold for now. Go neutral. Maybe take some profit. Wait for the pullback. A pullback is developing. It could last 4 hours or 4 days. Okay? And going back to now Richard's thing, I I can only be a bull. 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 There's no way ever, 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 ever that I could ever. There's no way I could ever sell this. Richard. Okay? And again, you're tough, right? You're strong. You're sharing because I know you want the feedback, right? So I would look at this in 2 seconds flat and say, there's no way in hell I could sell this. What do you want me to do one day? Let me know. What do you want to do on this pound? Let's go one day. What do you want me to do? Yeah. Nope. It's an uptrend, Richard. There is no double top. Yeah, right here. You want to see my track record one day? Okay, last month, so that's the last 30 days. Run a detailed report. Okay. Here we go. May, up to May 28th. My average loss is 26 pips. My average winner is 340. I still have 3 winners running right now, so that's why this is down. That would pop back up. So this was a $33,000 account. Now it's a $37,000 account. So what is that? 10% for the month? Now can we talk? I can't teach you if I don't talk one day. But if you want me to make decisions for you, send me $5 million. I'll work for you. All right, cool. Thank you one day. Cool. Got that. We're good. We're good. Okay. Well, pure mathematics, the S&P 500 averages somewhere between 8 and 10% a year, not a month. Cool. So anyways, I have very basic rules of engagement. And again, thank you to Richard for being strong and, sharing what he's doing and all that kind of stuff. He opens himself up for public humiliation and ridicule, but he's strong and he's learning faster because of it. And I don't care if this falls. I don't care if this drops a ton of bricks. All it would do is hit my stop losses, right? But I would never sell this because I have very strict rules of engagement. And that's that. I don't know right or wrong. I don't know the future. I just have rules of engagement. Okay? That's that. That's that. That's all I know about that. Let's do our commodities. Excuse me. Yeah, so like this, if S&P 500 drops, I will not lose money. Am I worried about it? No. Do I understand the risk that's involved? Yeah. And do I understand it could fall just enough to take me out, hit the 21 and then head back up? Yeah, but I would re-enter. It's okay. Do you see my averages when I showed you my averages? Okay. My losses, how do you say this? What's the right language? If my average loss is 26 pips and my average winner is somewhere between 300 and 400, 10x doesn't even describe the risk reward. The reward is 10 times bigger, more than 10 times bigger. That's a magnitude. That's right. That's 1,000% bigger. So how do you get that? Well, if this takes me out, I'll lose a little bit, and then I'll have an opportunity to try again off that 21. It'll be okay. And when I get it, let it run. Okay? Let it run. So looking at very basic rules of engagement, I set this one up last week. I have a little role reversal. I foretold, it was foretold this would come down. And it did. Right to the role reversal. Okay? Kicked off 30, which is huge, by the way. 30 on gold is nuts. And then, yeah, it popped. And we already did all of this. This is probably from the swing trading group Thursday of last week. And we have it going to 35. Oh my God, 35 on silver is unbelievable. But again, we already did this. Old news. Now, is it going to break through to the other side? Yeah, I don't know. So you have to think, are you going to buy another little dip? And then, what I teach in the day trading group is very often our trades are inside these wicks. Oops. Okay, we trade inside these wicks. So if you're going to make a high, that could get interesting. And you certainly, the next wick that matters is you never want to get that low. So now if you drop into a 15-minute chart, here you are in the day. Okay? And now you're trying to decide where you end up buying this if you're a bull. Remember, if you don't know if you're a bull or not, that's your problem. You shouldn't even look at a chart. And then I'm trying to teach everybody here, when you do look at a chart, okay, is this bullish or bearish? It's bullish. Well, what about the double top? There's no double top. How do I know? I'm bullish. Now, if one develops, it'll change things and it'll become a bear, but I don't worry about it. I'm a bull. It's going to go up. I've already made my fundamental and my technical decision. Okay, you look at gold. Maybe you want to trade gold. Yeah, it's bearish. Whoa, it's bearish? Yeah. Yeah, it's bearish. Technically. Look, right in here. If I was a bear, I would sell that hard, bro. Okay, why? Well, maybe inflation's coming down. Maybe we don't need to own it anymore. I don't know. Okay, but let's say I'm not a bear. Let's say I am a bull. Okay? And look, it went up on Friday, it went up on Monday, it rallied on Tuesday. I don't care. Okay? I'll see you and do this when it's ready. It's too early. I'm risk averse. I only want the winners. Okay? And I have hardcore rules of engagement. In this case, it's bearish. Done. Now, you can check the daily and say, well, I'm looking at it on a higher time frame. Okay, but it's still a wait and see type thing. Okay? It's still a wait and see type thing. You could, on this time frame, be a bull. But remember now your stop is way significantly different. Imagine you had to put a stop below this. $250 stop. You're like, whoa, whoa, whoa. Okay? Well, if you can't handle that, then you're on the wrong time frame. Okay? On this time frame, okay, what you're saying is it made a 618. So somewhere between the 50% and 618. And then you're looking at next week or next month's buy zone, which is here. Oh yeah, okay, yeah, sure. Under those circumstances, yes. But I think you could lower your risk by dropping into a smaller time frame and be able to get in near this price, but with less risk. Okay? So you have to decide, where are you on this one? I think I could wait, okay? I could wait for the 21 to go above the 55. If you're going to be a little more, take on a little more risk, okay? Then you have these role reversals going on, right? But to each his own. Okay? If you're like, well, I don't like that unclarity, then don't trade it. Okay? Bitcoin came down. I set it up last week to measure the drop. Okay? Yeah. What does it say here? What does the chart say? It says the same thing as it said last week, but I'll kind of update it a little bit. Somewhere around 66 might be a decent buy. If you're a bull. 66 to 76. Okay? You see that? You're just riding the 21 on the daily. But you're like, but Wayne, I haven't traded this in 1, 2, 3, 4, 5, 6, 7 days. You're like, yeah, well, time to get ready. Lace up your shoes, boy. Okay? And I look at things like, I don't know what the market wants to do today. So we got to pay a lot of attention to that, right? Dow is down. S&P 500 is down. NASDAQ's down, but that could be a little buy. That could be a little buy if you're a 4-hour trader. That could be a little buy. Or should I say a goodbye? Bye, bye, bye. Maybe, right? Where are we on the daily on this sucker? Yeah, that's somewhere between the 5 and the 8. Yeah. If you're a bull, okay. Now, if you are a bear and you're like, okay, this is time for this to come down, Okay, that is a good number for you, by the way. At some point, what we want to see if you're a bear, some point along the way, you want to see a good old top, followed by probably a lower high, lower low. And you can put these together over time. So you can try the first leg, but just be prepared to get knocked out at break even. And then you can try the second leg, which is better, because I never sell one-offs is what I call it. Oh, it topped out at a key point. I don't care. Now, a double top gets interesting. And then a lower low is totally game on. So this is like, no, you probably shouldn't do it. This one is definitely should. Well, probably. And this one is extreme. Like, if you don't do that, you're not a bear. You're not trading. You're not trading properly. Okay? So, look, it's too early, I think, for bears. Okay? I think it's going to come down to the future 21 if you're a bear. And then kick all the way back up. And then if it's going to turn bearish, it's going to do it here. And if you're wrong, bears, we're going to the next level. Okay? NASDAQ 20,000. Okay? I mean, it's actually 20,003.8. Okay? Yeah. Oh, for sure. So anyways, cool. Yeah, Dow's been pointing the way the whole time. I think the only thing that's going to save NASDAQ today is the idea that Apple can actually sell phones again. Yeah, that's funny, huh? Sell phones. One more time on WTI. We've had this lined up over and over and over again. Okay? Oops. Ah, come on. There we go. Try it again. There we go. Okay? Over and over and over. And really, that's two. And now we're on the upside. So be careful. Okay? If you're a bear, this is what you want to set up. If you're a bull, this is what you want to wait for. Okay? So we're nearing $80, right? Okay, here's the thing. Bulls buy at 80 and bears sell at 80. Okay, but there's a right way to do it. There's a right way you do it. That's how bears will do it. That's how bulls will do it. The price doesn't change. All right, I think that's it. Yep. All right, so today at 4 in the day trading group and the swing trading group. In the swing trading room, I am going to go and read economic reports from around the world so we can do fundamental analysis together. That's nice, right? You should join the swing trading group. It's not a lot of money. And if you go to tradars.co/summer school, okay, we are going to teach you how to pull the trigger. You're not just teach you, you're going to participate. You are going to learn how to have the right skill and the right confidence, okay, through real world interactions in the live market, but also in simulation. You're going to learn how to pull the trigger like someone going to a driving range with a coach hitting 10,000 golf balls. This will have a real practical difference to your trading. Tactical. It's not going to be hours and hours and hours and hours and hours of lectures where you just sit there and go, yeah, that's good. Yeah, that's good. Yeah, that makes sense. No. This is rolling up your sleeves and getting your fingernails dirty. How much? Less than $10,000. So go here. It's not even $9,000 or $8,000 or $7,000 or $6,000 or $5,000. Yeah, I got it, Miro. I've already sent it on to the developers. We'll get you covered. It's not $5,000 or $4,000 or $3,000. There's going to be a lot, Mikhail. The truth is, because it's a combination of lecture and technique, it'll be a month, multiple times. We'll keep going until we're done. But there's a lot. So I think I put here 18 hours to give you a sense, but I wouldn't be shocked if it's more than that. So money is not the issue, right? It's not even $1,000. It's not $900. It's not $800. It's not $700. It's not $600. It's not $500. It's not $400. It's not $300. It's not $200. It's not $199 or $198. This will make a difference, and you care or you don't. It's that simple. Money is not the problem here. You'll see. Go ahead and join. Sign up. It's so underpriced that if you don't care, you don't care. If you care, then you'll sign up. If you want to see an actual change. Okay? I would suspect every single person here should be in it. It's just that simple. All right. I got to go. So I'll see everybody at 4. Yeah. Yeah, well, that's good. This is summer school. And you're a member of TRADARS. Great. They're two different things. Yeah. One is summer school. And you really should have access to TRADARS. You really should. Because these are tools that are being used, right? So anyways, I love you, babe. That was real. I'll see you at 4 p.m. Everybody go to investorbootcamp.com and join the swing trading group. We are going to read economic reports like you're a professional. If you want to become a professional, then you need to do this. Peace on earth. May the pips be with you. May our profits be above average.